Good morning, Sense of Things audience. Merry Christmas, Happy Hanukkah, Happy Festivus for the holiday for the rest of us. It's Ron and Jeff here. Ron, how you doing, bud?
Good. Did you, for Festivus, did you bring your poll for all the grievances that you want to air out today?
Absolutely. I have it. I double use the pole behind me that I use for my green screen. It is a tall metal pole, so I shall be using that, and we will be airing grievances and wrestling tonight after dinner. So
We might need a separate podcast for the grievances.
I'm sure. Yes. My grievances to the crazy ass market that we've dealt with all year.
Oh my God. All right. Where do you want to start?
Well, why don't we start with some funny headlines for the year?
Please.
So let me share my screen here. I thought this was pretty funny. I was having some problems. It was on BuzzFeed, and I was having some problems with BuzzFeed. But I thought these would be a nice way to end the year since we finished last week with the top stories from our Florida man.
Oh yeah.
Thought this one was actually funny. I was driving down the highway at around midnight and suddenly saw a dude with a whole real life adult two-humped camel in the back of his pickup truck. I definitely had to do a double take, which with a double humped camel, you have to do a double take, I would
And
think.
they're not even wearing seatbelts. That's terrible.
It's horrible. You could have that camel get launched off. I thought this one was good too. I was driving through town with my husband and saw a woman riding next to our car naked. Then another naked person on a bike appeared and a whole bunch more. They were literally all naked, but their bare butts on the bike seats pedaling away. I guess there's a group called Naked Bike Riders, and I was lucky enough to see them in action. It was absolutely surreal.
I don't know
Okay.
about you, but it's tough enough to go long distance on a bike seat, let alone naked. It ain't
Yeah,
happening.
naked. Yeah, at least if you've got, if you've got bike pants on, at least it's a little bit more comfortable. I can't imagine riding on a bike seat with that.
No,
I love this one. One time I
definitely
was
a good
checking my
one.
mailbox and found a flyer for a pizza place. I was reading it while walking back to my place. Then all of a sudden, a half-eaten piece of pizza fell from the sky and nearly hit me. I looked up, bewildered, and saw nothing but a very sad-looking squirrel on the roof, devastated that he had dropped his dinner.
Hey,
I,
listen, this has got to go over well with the woke people. It's all inclusive of squirrels.
it is all inclusive of squirrels, and there's something to that combination there of reading the flyer and getting hit by pizza. Yeah, this one was stupid. All right, here we go. I love this one. Still don't get it. I was riding in the metro in Washington, D.C. during rush hour. It was a hectic morning, so the cars were jammed. Like people were pressed against the train doors. I was waiting at the station on board another line when I looked up and saw a man on the train making out with the window. He was full on French kissing the window pane. It almost felt as if I was intruding on something. I don't know what was happening and where this guy was in his head, but it was the strangest thing I've ever seen. I've been on the Washington, D.C. Metro. I
Bye-bye.
don't even want to touch it with my hands. I cannot imagine touching it with my mouth.
Jeff, I don't think we should be berating this guy. Just sometimes you got to love the one you're with.
That's
For
true.
the immortal words
You
of Stephen Kikel.
absolutely have to. It's an absolute must.
Yes.
Uh, this one, I shall leave this one as the last one because I thought it was pretty funny. This is just a really weird sequence of events. One time I was doing a bar crawl about 7 or 8 bars in. We got this really rough looking one. This guy came in and I noticed he was wearing a pirate hat, had a parrot on his shoulder, and he ordered a drink. The parrot was repeatedly shouting a string of curse words. Nobody said anything, so I assumed this dude was a regular or something. When I bought my drink and went into the beer garden, spotted my friends at the table and saw there was a Shetland pony standing next to him. So it just sounds like a joke already. A guy or a pirate,
Yeah.
a profane parrot, and
We're
a
waiting for the
Shetland
rabbi
pony.
and the priest to walk into the bar next.
Absolutely. I just don't know where to go with it. The fact that he was 7 or 8 bars in at this point, I've got to wonder if the pirate
Could have
was,
been some hallucination in there
yeah,
too. Maybe this was around Halloween. There's a lot of factors here they're not aware of.
it could have happened that way. I just really don't know what to say about it. But so just shifting gears from that, I wanted to just talk
Yeah.
about some stuff coming up that was today, the economic or calendar econo day, the last GDP of this year or for Q3 basically just came out. The consensus estimate was 5.2% up for the year, and the range was 5 to 5.2. It actually came in at 4.9. So it's not coming in as hot as it has been. Of course, that kind of fired the market up even more this morning because the belief that the Fed's going to lower interest rates, which we heard from the Fed chairman this week, or I guess it was last week, that it's possible that they'll lower it 3 times next year. Of course, then the market extrapolated that to mean 7 times, and that's caused the market to go through the roof. Once again, don't really get it. Interesting too, the annual rate on personal consumption expenditures went down to 3.1%, and that had been estimated at 3.6.
That doesn't surprise me because they did say this holiday season was up a little bit, but spending was down. You tell me how those numbers work. I don't know.
And personal consumption also includes things like rents and things along those lines. So it's interesting to see. I don't know, and I haven't really dug into the numbers.
Yeah. I don't know. Like I said, we'll end up seeing revisions on this for the next couple of years.
Oh, I'm sure. Yeah, that's a given. I think we did one episode where they're revising still stuff back into like 2008.
Yeah, that was about 3 or 4 months ago.
Yeah. Jobless claims came in line with what was there, actually a little bit less than consensus today. Once again, the 4-week moving average is up around 212. That's right in line with what had been expected. We're not seeing, and I think that's been the thing we've talked about with this, as long as jobs are still there and we don't have massive amounts of layoffs, the market just keeps on chugging. You wonder where people are going to run out of money, but it just keeps on chugging because people still have jobs.
Look, obviously all the seasonal people will be let go in a couple of weeks. There's been Hasbro, toy companies laying off 10,000 people or something like that.
Yeah.
We talked about the trucking line, Maersk, one of the largest trucking lines. They're laying off 10 or 20,000 people, whatever it is. January and February, typically 2 big retrenching months with companies. We'll have to see where that is. The market's gone up in a straight line. There's got to be some type of fade, just even to the medium, which I think on the S&P is around 4,400, 4,450 from my charts, just as a little bit of exhaustion and profit taking. But look, we've said this before, those fund managers propping up their performance for Q4 for the year because last year stunk. So they all want their bonuses. So will they be harvesting profits in the last week? Will they do that in the beginning of the year? We'll have to see.
Yeah, I think I honestly think it's going to continue to blow through the end of the year, and we'll see what happens the first week of the year. I just sense we're just going to continue to go up. Now, we're going into the week between Christmas and New Year's, and typically that's a pretty low trading week. So it could go one of 2 directions. It could be real volatile, or it could be just that continued steady uptrend on low volume going forward.
I think typically, as we've seen over the years around holiday times, Thanksgiving, Christmas, New Year's, that a lot of the more thinly traded stocks get pushed around a lot because they're just being manipulated by algorithms because of the thin volume. But the bigger stocks, again, why wouldn't people take profits, some profits here before the end of the year when we're trying to almost short-term top tick many of these? So it'll be interesting to see. But yeah, I still think there's some more upside. How much more to be determined, but we'll have to go through it. All right, I wanted to go through just some charts. The CNN puts together some of their anywhere between fear and greed charts. And I thought this was interesting because on the left-hand side, we all saw this in the last 7 weeks, right? Good stock price breadth, market momentum, good stock price, the strength. We all realize where it's at, right? The market is overbought, right? That's why we're just talking about it's due for a pullback. But I thought the right side was interesting. So the safe haven trades, what are the safe haven trades, right? Bonds, CDs, whatever it may be. Putting money in a place where there's very little or no volatility at all, risk-free, whatever you want to say. That's that extreme fear. Now, we know 7 weeks ago, the 10-year just peaked over 5%, and now it's around 3.9-ish. So does that mean there's extreme fear? People are selling the asset values are going up. I
Yeah.
thought this was interesting because they're still doing auctions,
Mm.
treasuries. They're still printing more money. How is this extreme fear? And I thought the other interesting thing was if the stock market has been flying in the last 7 weeks, and we got this extreme greed with momentum and breadth, why is there such high junk bond demand?
Yeah.
My opinion, because with the safe haven demand and the junk bond demand, people are putting money where they're going to get higher yield and less risk for at least a shorter period of time, at least for the next 6+ months. So
Mm.
what are people thinking about the market and the economy in the next 6 months? So I thought these 5 charts were very telling. As we said before, every chart tells a story. What do you think?
No, I totally agree. And I think it's just what I think overwhelms all of this at this point is interest rates. I don't think people are looking at any other fundamentals besides the fact that they're trying to anticipate that we're going to see a bunch of interest rate drops in the next year, and they don't care. It's just whatever the valuation is, the valuation is, and I'm just going to pay. I'm going to keep riding this because you don't fight the Fed and all that. I think that's a bit short-sighted, because it's interesting when you start to watch some of these, and we'll talk about interest rates later, but you saw the Fed chair come out and say it's very likely we'll drop 3 interest rates, which of course the market extrapolated to be 7 interest rate drops next year. And then you're hearing all the other Fed governors walking that back, that, hey, we're not sure where this is going,
This is my frustration with financial media. Jay Powell did not say we're looking at 3 rate cuts next year.
Yeah.
And I had some clients reach out to me to say, oh, this is what the Fed said. And I'm like, no, they did not. I said, number one, they would never tip their hand
No.
on what they're going to do. They're always going to say data dependent. They're always going to say it's on a meeting by meeting basis. And even when the other governors came out, whether they're voting or non-voting, they just said higher for longer, and we'll see what happens. They all say the same thing. It's the Fed futures market.
Of course.
When that Fed futures, it should be when they say it gets over 50%, but even at 30 or 40%, oh, they're anticipating a rate cut. Even at a 30 to 40% Fed future rate? I'm sorry. So it's just great financial media fodder. And unfortunately, the average investor out there is reading headlines.
That's exactly
and it's
right.
very
And that's all
frustrating.
they
And
care
you and
about.
I know, we've talked about this. If they do lower rates, anything more than 1/4 of a point, either in one meeting or over a couple of meetings, means something happened bad in the economy, meaning that credit got too tight and they need to free up some credit and some cash. So anything more than a couple of straight rate cuts means the economy, something bad in the economy, and probably the market's going to pull back 10 to 15%.
Absolutely. Yeah, absolutely. That's the thing. And I think the other part is I go back to this. I've said this multiple times. You and I have both been in the markets for well over 25, 30 years at this point. The average mutual fund manager today is about 40 years old. So that means they basically started in the industry after 2008 at this point. So they've really never experienced a lot of the craziness that we've experienced in our careers, and certainly have not experienced high interest rates. And when you look at history, honestly, these are not necessarily high interest rates. They're high in comparison to where they were a few years ago. They're not necessarily that high in the long scheme of things if you look at history down the road.
Yeah, look, we've talked about this before too, because a lot of these fund managers are just spoiled for what they've seen in the last 12 or 13 years.
Yep.
But not only that too, but there is no will on the political side to bring down our debt.
No.
And I think, who knows the timing? It could be 6 months, it could be 6 years, it could be 30 years down the road, when at eventually some point that comes back to bite us in the rear end, whether it's taking away our currency reserve status or something else happens. That is unsustainable.
I think we're seeing it in the Treasury auctions. Even Janet Yellen recently said that they're going to tend to auction in the shorter term versus the longer term stuff, which is the smarter thing to do because longer term rates are way the hell lower than shorter term stuff, but people just aren't buying it at this
Yeah.
point. And I think that's the embarrassment is people are looking at the long term and saying, okay, it really is probably only going to go up on the long term side. One, because the curve will invert or revert back to where it is. But two, yeah, people are not willing to bankroll us in the long distance because they don't know where this thing is going. And you see the credit rating agencies lowering our credit. Of course, we've seen it overseas too.
And that's another reason why I think the junk bond demand is at greed.
Yeah.
Because people are looking for yield and maybe even even a high junk bond status, if there's such a thing. Even a high junk bond status, those are still solid companies,
Yeah.
may not have a pristine balance sheet, but they're yielding 6 to 8+%. Why wouldn't money flow into that?
Yeah, and I think the other side of it with our portfolios that we manage, we tend to I have a core component of those portfolios that are in BDCs and which are business development corporations that are in corporate debt, senior collateralized corporate debt that are in CLOs, collateralized loan obligations. And all of those yield way higher than junk bond. That's what makes me laugh. People are like buying junk bond funds, and I'm looking at them and going, okay, so you may make 5%. I make on average about 12 to 15% from CLOs and BDCs and things like that. And those are way the hell less risk than some of the stuff here. And the majority, 70 to 75% of companies that are out there in the world are unrated, that they're not in the junk bond status. They're just not rated at all because they're not big enough. That's the funny part I have with this is people focus on the junk bond side. And I'm like, okay, you're not really getting paid enough to take on the added risk of default risk.
No, but as a portion of your portfolio, it's not bad. The next thing is to look at some ideas for next year,
Yeah.
either being positive or just looking at rotations. And I thought what was interesting, I know I've shown a similar chart like this before, and I'm going to tell you why I love this chart, right? Being a little selfish for a moment.
Because
That
it's
if you
really
take a
pretty
look,
and has lots of colors, or
no, it's not because it's all ribbon colors and everything, but it basically is giving you the markets, but in different slices, even though there's a tremendous amount of overlap. So I'll go through a couple. Everybody knows who the SPY is, right? And
yep.
you can see with the SPY is up around 128% in the last 9.5, 10 years. But then you have SPLG, which is Standard & Poor's, basically large cap growth stocks.
Okay.
VOOG, everybody knows. A lot of people are in VOOG. That's the Vanguard Growth. FTC is the first trust alpha dexing where it's basically very similar to VOOG and to SPLG, but it's adding more to anything that's got more alpha on a quarterly basis. OEF is the S&P 100 stocks. NTUM is very popular because this is the fund that actually adds more money to the stocks that have momentum on a quarterly basis. And then, of course, one of my favorites that I've been tracking for a long time, I got clients in this 12 years ago. I love looking at their unrealized gain loss because it's so high because of how well it is, and that's Moat. So anybody can look up Moat. I would go to Morningstar because Morningstar actually sponsors this fund. So everybody knows, who Warren Buffett is, and Warren Buffett talks about looking for competitive advantages, looking for companies that have a moat around it, meaning that it's tough to penetrate their market share. Moat looks for companies that have a wide moat, not a narrow moat, for a competitive advantage. And what we see here is Moat and VOOG have performed almost, identical over 9 years, even though there's a lot of EKG in there, much better than SPY, much better than even OEF, which is one of the benchmarks that I follow because it's an equal weighted top 100 stocks in the S&P. So I thought this was interesting because we were talking about this in our pregame. Why would we put money right now into a market where we're top ticking short term? And I'm saying these are the type of funds, ETFs that you look into that you don't care whether they're top, bottom tick. You just do consistent contributions in there, and over time, you see it compounds in your favor.
Yeah,
So I'm sure
absolutely.
you have clients in a few of these too. I don't know if you've looked into mode in the past, but
Mm,
a lot of people focus it on the big brand stuff, not
yeah,
necessarily other things that still have a lot of assets behind it, but obviously also excellent performance.
absolutely. Yeah, and I've used moat in the past in portfolios as a core position there because these are companies that no matter what happens, they're going to figure out how to make money at that point, and it's so difficult for somebody to penetrate in that they just can keep chugging along, and they're not going to knock your socks off, but they're also just going to keep chugging along.
And there are several stocks in the top 10 and top 20 of both that are top 10, top 20 of the other ones.
Yep.
But they have other companies in there that have done well over time
Mhm.
because of their competitive moat. All right. And my last slide is talking about sectors. So
Mm.
sector rotations, and I'm not going to say trading because I don't like to consider myself a trader with clients' money, which I'm not. But when you're looking for some alpha going into the next year, right over here, this column here is the year to date for 2023.
Mhm.
I only look at the bottom four sectors. And you
Mhm.
can see anytime healthcare was in the bottom four, the type of rebound that had over the next 12 to 24 months.
Yeah.
This isn't a recommendation, but if you take a look at all of the returns with healthcare, right, annually, it's up about 11.5%. This year, it's down 4.1%. So if we just look at average performance going in the next year, there may be a 15% bump, 14, 15% bump in healthcare, if not in the next year, next 2 years. We'll have to see. The other one that I like in here is the consumables, the consumer staples.
Mhm.
Now, interesting enough with consumer staples, I don't know why they were down this year.
Yeah.
Uh, it's just odd, but typically when consumer staples are down, they will typically have a nice little bump. You can see here in the past how they bumped up. They were down here, came bumped up. It's very rarely do you ever see 2 or 3 years in a row where consumer staples are in the bottom four. Why? Because we all need to buy what's in those companies, the Procter and Gamble, Kimberly Clark's, Colgate, Kellogg's of the world. So I just thought those were two ideas to consider if you got some cash on the sidelines or some T-bills maturing, looking at
Mhm.
the next 12 to 24 months, obviously you could buy a sector, or the other suggestion, and I want to hear your thoughts, is you look at the top 5 holdings in a couple of these sector funds, and you put money just either into those top 5 holdings or into 2 or 3 that appeal to you the most and have the lowest PE ratio and the highest dividend yield.
Mhm. Yeah, and I think it's likely to be a good year for dividend paying stocks
Sure.
across the board. I when I buy dividends, I tend to buy dividends of companies that either companies or funds. So I'll buy closed end funds that don't really rely on that constant cash flow coming in, and basically they distribute most of their income in the form of dividends. So I really don't care about the value of it. The value just tends to stay flat, and there's predictable dividend. That's been a great strategy throughout this year for our portfolios. I think it's going to be a good strategy going into next year because anything that's got dividend payments, as we see these short-term interest rates, and I think my thought process is if you look at the yield curve right now, and we'll look at it in a minute, the yield curve is really high on the short term and relatively low, although getting closer together on the long term. So the yield curve is slowly uninverting at this point. So it's very likely that we see a move down next year, especially if we see some interest rate cuts. Those short term rates are going to come down, and then dividend stocks are going to become very attractive again.
Yeah.
Specifically, those dividend companies that just continue, if you look throughout their history, they just continue to raise dividends steadily over time. And if they pay out, let's say 50% of their earnings in the form of dividends, and they raise their dividends over time, those are the kind of stocks that you want to look to own in a market where potentially rates are going down, which means probably something else is going on in the economy at that point. And they become more and more attractive because they're raising their dividends over time. It's not a fixed interest rate. It's not a short-term rate that's massively dropped down. You look at some of these companies here, really in healthcare, in consumables, and real estate, and utilities, those four lowest categories, all of those are pretty well dividend payers.
Yeah, and
And
also utilities rarely ever get to the top. They got in here a couple
no,
of times, but
yeah,
they're not, I mean, utility, they're not meant to do that. But I'll get some hate mail if I don't bring this up because I've showed this chart to clients looking at some next year, investing thoughts. And people are like, what about energy? Anybody that has ever talked to me or have known me knows that I don't get involved in energy because
mm,
oil is one of the most manipulated markets in the world. And
yep,
I thought it was interesting. Energy has done so well the last couple of years. Yeah. But look what it did in the 7 of the 8
eh,
prior years. You made nothing, you lost money. So yeah, you finally got it if you stuck in there for 8 years and you made money in the last 3.
yeah,
But my whole point is too much EKG in there.
mm,
Look for other things, even for, and whenever I get a client into investment, I have a 3 to 5 year outlook, right? I'm looking for a 20% upswing in the next 3 to 5 years for growth oriented strategies and clients.
yeah.
So that's why healthcare is a good fit. Energy, forget it. Throw a dart.
Yeah,
It just
it really is.
yeah.
And I just don't like anything that is manipulatable as well as commodities. I just don't like commodities. You'll have people
Yeah.
say, "Oh, I want to be in gold and all that." Once again, if you look at gold
Yeah.
over the last, I saw this stat one time. If you looked at gold over the last 80 years, it has appreciated less in value than a man's suit during that time period. And it doesn't have dividends, so it doesn't earn income.
No.
It's all completely
You
manipulated
don't
by
know
what's going
supply.
on in the market.
You don't know supply. And
Yeah.
that's my biggest issue with gold, silver, copper. Copper to it is a different story. But
Mm,
gold, silver, and oil. Can you
yeah.
tell me how much gold is in the ground and how much has been mined? Can you tell me
Yeah.
how much oil is still in the ground and how much has already been pulled out?
Mm,
It's all manipulated.
yeah.
So that's why I keep away from
I'm
uh,
with you.
I keep
Yeah.
away from things either I don't understand how price works or you can't identify supply and demand because then the fundamentals of it become too funny because it's like juggling jello. You can't get a hold of it.
Yeah. And I think the newest of this crowd, of course, is cryptocurrency. And I spent a good solid 3 months this year going through some training in cryptocurrency, really looking behind the scenes. And my take that I came out of this with is it reminds me so much, especially when you get deeper into it. People see the top layer of Bitcoin or Ethereum or something like that. There's a whole layer of stuff way down below that of all these different crypto projects and things like that. And it reminded me so much of about 1998 to 2001 of so many of the .com stocks that you have this whole crowd of people that are all trying to chase the next thing that's going to make you a billionaire and all this. And I started looking at it and I saw the risks behind. I think the training that I went through, I spent literally the first 3 weeks learning how to protect my crypto assets so that somebody didn't steal them. And I have no interest in being in a market like that where I have to worry about that stuff. We have what's called a crypto halve or a Bitcoin halving that's going to happen probably in April of this year. So you're going to see Bitcoin probably tail up just because they do this. It's effectively a manipulation of the Bitcoin market where they say, okay, we're going to create half less of crypto or of Bitcoin going
Yeah.
forward. And so that always seems to be a big rise for about 18 months and then it drops like a stone. And if you look at history, it's been up and then boom, it drops for a stone for 3 years. And then in 4 years, they do another Bitcoin halving and it goes up. And once again, it's just something that I can't figure out. There is no logic as to why it goes, where it goes, as all the other crypto projects.
They say it's
So
supply and demand because there is a limited supply. And I'm saying to myself, no interest.
Yeah, no interest in it. I don't understand how it works. It's just like any other commodity at that point. So it's all kind of manipulated and really no interest in that area. So I tell clients, if you want to invest in that's
I
your
got it.
own, do it yourself, but I won't do it. I put in the effort and the time. I'm not like most advisors that are like, I'm just not going to do it and I'm not going to learn. I spent the money to learn and came out of it with my personal belief that it's way more work to figure out where to make money in that market. And there's way more risks of potentially losing your money, not just in the form of losing it in value, but losing it just literally being stolen from you. And there's no recourse in those cases. So just no interest in playing that.
I hear you. Did you want to show something else?
The only thing I wanted to show, and I think this is important for people to understand at this point, we've shown this before, which is the Treasury yield curve. So I want to share once again, and we'll finish with this.
That's a fun website because of the historically how you could go back.
Yeah, it's fun to go back and take a look at it over time. Here, as of this morning, this is the Treasury yield curve. The 1 month Treasury bills are sitting up here at what, 5.5%. You get out to a 10-year, which if I can get this garbage out of the way, our 10 years are down here about 3.86%. 20 years, it's interesting that the 20-year part's been starting to tail its way up a little bit. So that's at 4.17. If much about Treasury yield curves, typically the farther you go out, the higher the rate is. So what I would tell people is this is what the market is telling you is the rate that we'll get to eventually.
Now,
The bond market is
enough,
saying we're gonna settle in around 4.17. So what does that mean for people that have moved out of money markets and bought Treasury bills or whatever? All of these, you start to go out to 1 year, it is very likely when we start to see interest rates cut, these are the fastest things that are going to mature. They're going to drop. If we were to go back in history a little bit here, and let's go back a couple years to a normal Treasury yield curve, probably March, February, look, January of
probably anywhere in 21.
Yeah, 21, we should be fine. That's a normal curve. Short end was, this time it was ridiculously low, but then you had the high end around 1.65. The 20-year was at 1.45. So that's normal.
And this is what got
December
Silicon Valley Bank and many of those other banks in trouble because they were all loaded up on 20 and 30-year. And then when rates went the other way and they had redemptions, they lost their rear ends.
Absolutely. Yeah. So we go back to today and it changes dramatically. And you need to understand that if you're currently invested shorter term and you're looking at, and honestly, I think Ron and I have been that way. Why not stay in those those shorter term rates? Why not do that? But just realize that 5% that you're earning today is very unlikely. As we start to see interest rate changes, it's very unlikely that those rates will stay where they're at. And you could see those evaporate pretty quickly. Yep. But I think the market's kind of giving you a little bit of not a head fake, but a little bit of an idea that it's likely we'll settle in where those longer term rates are about 4.17 on the 20-year. The 30-year will come up slightly higher than that to maybe like 4.40. And then we'll see the shorter term rates all tail off. So that's that end of the curve. Typically, this is telling us there's a recession down the road. Now, is that going to be a strong recession? Is it going to be a recession where we see it be a soft landing or a real hard landing? Who knows at this point, but it's very likely that at some point something is going to happen that's going to cause this to go back to what's more of a normal curve.
Before we get off of this and wrap up here, I want our audience to look at the first 6 months, right? It's still yielding better than 5.2.
Yeah.
Go back to October 20th of this year, 2 months ago.
Yeah.
Not much change.
Nope.
What I'm trying to say is that the smart bond traders, and I am not one of them, I follow them and I understand what they're saying. When there's all the meat is in the short end of the curve, that's fear. That's fear because They don't want to invest 5, 10, 20 years out. They're like, I'm going to keep my money short term. That curve did not change much for the first 6 months. In the last 2 months, even though the 10-year has gone down by more than 100 basis points.
Yeah.
So this is still telling you can still get some decent yield and protect yourself in the next 6 months, even if the market shoots up another 3 to 5%. At some point, it's got to get grounded. We shall see. But
when that happens, who knows? Yeah.
But even with major moves in the back end of the curve, the front end of the curve still has all the meat.
Absolutely. Which, once again, they don't want to take the risk anymore. Last thing I wanted to show is this is off of bankrate.com, 30-year mortgage rates. If you look at 30-year mortgage rates now, fixed rates, they have come back significantly. And
I didn't realize they were under 6. I thought they were.
You can get into the 6 range, 6.25 here. Now, some of these are promotional rates or whatever, but you can actually get into the 6s, which a few months ago, if you went back 6 months ago, most of these rates, even these promotional rates, were well into the 7s, high 7s, even some low 8s. What that tells me is my friends that are in the mortgage business and my friends that are in the real estate business, it's coming to where things are going to become more affordable. Yeah, the rates are making it more affordable at this point. And as we see rates come back, especially those longer term rates, that's going to make it realistic again for people to be out there looking at real estate, mortgages, and everything else.
I think once rates dip under 5%, 30-year fixed, that's when a lot of the refis are going to start to happen. We will probably see more inventory of existing houses get on the market.
Yeah. The other part is too, you're going to get those existing houses because people are like, okay, I can at least move now. I'm not going to get an 8%, go from a 2.75 like I have on my house to 8% mortgage. I'm not moving. But if I can go to a 5, okay, that's not that bad. And I know I'll probably be able to refi somewhere soon at that point.
We'll see where things go. I think Q1, I'm finishing up my market outlook for next year. I'm sending it out on Tuesday. I got to tell you, I thought coming into this year, there were more uncertainties and more unknowns and more scary stuff to think about. I was wrong. I think next year it's tough. You want to protect your clients, you want to protect your money, but the presidential election on top of everything else we're dealing with, holy crap.
Yeah. I mean, you got all kinds of craziness going on in this presidential election too. It is going to be the weirdest year I think we've seen in a long time, because there's a perfect storm of a bunch of things all hitting at the same time. I think the good thing is the Fed did do what they did. They'll talk about this for the next 60 years about what the Fed did during this time period. But I think the one good thing that the Fed did well is they raised interest rates like crazy, and even more behind the scenes, they shored up their balance sheet massively. So it leaves them with a lot of dry powder at this point. If we do go into a significant pullback in the economy, they've got a lot of dry powder to help keep that going at this point.
Yep. No, I agree. And hopefully it doesn't get political, but we shall see.
It's all political now. Everything is political now.
So actually, to wrap up, in honor of your shirt, I just want to wish you a yippee-ki-yay Christmas, my friend.
That's absolutely true. And happy Hanukkah, my friend. I appreciate you every day or every week we do this. I hope everybody's enjoyed our year doing this so far. We're coming up to our year anniversary somewhere around February. I forget when we started the show. Look forward to another great year of getting on here every week and having these conversations and sharing this with our audience. This will be our last show of the year that you'll see. Hopefully we'll get going in the next year and have a lot of good fun talking about what's coming up. And hopefully we'll be here to navigate the craziness with you. So thanks a lot. Make sure that you hit that subscribe button if you have the opportunity to, and hit the notification, the little bell, so that you know when we pop these shows out. And we will see you after the beginning of the year.
Happy holidays.